What if I told you that investing a little bit consistently could actually save you more in the long run? In this video, I'll show you 3 different investment scenarios and how dollar cost averaging led to the best outcome, even when the market was unpredictable. Stay tuned to see why this strategy might just be your secret weapon to build wealth. Welcome back to Simply Money. Today we're looking at the power of dollar cost averaging. This is an investment strategy that you should look into as being your primary way of building wealth. Stop trying to time the market. Stop trying to find the best time, the biggest dip, when to buy, because your emotions will get the best of you. 85% of managed funds end up doing worse over the long run than the benchmark S&P 500. Why is that? Because even professionals have emotions. Even professionals don't know where the dip ends. They don't know the best ultimate time to buy. And that's why dollar cost averaging wins every time. You don't believe me? Let me give you a scenario. Let's say we have $250 that we're going to invest over 10 periods. And we have 3 scenarios. In all 3 scenarios, the first time we buy, it costs $20. So $20, and we get 12.5 shares on the first time we buy for all 3 of these scenarios. Now let's look at the end value of that share. For scenario 1, it's $30. For scenario 2, it's $22. For scenario 3, it's $18. They started at $20. Scenario 1 ended at $30. Scenario 2 ended at $22. And scenario 3 ended at 18. Which scenario do you think had the best portfolio value at the end? Leave a comment down below. Pause here and leave that comment. I'd be curious to see, do you think scenario 1, 2, or 3 would have the highest end value of that $250 invested 10 different periods with a different ending balance? Theoretically, we would think, oh, the value that had the greatest gain would have the greatest value overall. But that's not the case. I'm going to show you this as we break it down scenario by scenario. First, let's look at scenario 1. As you can see, the price started at $20, and this is how many shares you get, $12.50 investing your $250. And if you look at the price through the 10 periods, it's either the same or goes up each period. Never goes up a significant amount, but it does go up period over period. And your ending average price was $24.80 because you would pay $250. Even at this $30 level, you get 8.3 shares. At the end of this scenario, have 102.7 shares with an ending balance of $2,547. Now let's look at scenario 2. Again, we're investing the same $250 over the same 10 periods, but with this stock, it started out at $20, went up to $22, went down to $20, then $15, started going back up, got back up to its highest at $22, went down to $18, then back up to $22. As you can see, the number of shares that we purchase, sometimes it's lower, sometimes it's higher, where in scenario 1, it was constantly going down a little bit because that share price was constantly going up. At the end of this 10 investment periods, you have 129.7 shares. So you have 27 more shares in this scenario, even though the ending price is only $2 higher than the starting price, and it's $8 less than the original price. Why is that? Because you were dollar cost averaging, buying in when it went up and buying when it went down, accumulating more shares. But your end value was slightly less. $6 less because of how the scenario went. Even though you have more shares, the average price was only $19.60. But let's look at scenario number 3. You have the same $250. You're investing it over 10 periods. The first investment was the same $20, so you get the 12.5 shares. But look what happens on this one. It drops to 15, 10, then it begins to climb up. And right here, a lot of people would be like, I am done. You've lost half of your investment. Your investment has decreased by 50%. It went from $20 down to $10, and you think, I'm in a lemon. I'm in a bad stock. I'm going to get out of this. But if you consistently dollar cost average, and then it slowly started creeping back up, and it only got to $18. Your ending average cost per share was only $14.70. So you were able to accumulate 177 shares versus 129 and 102. And look at this, your end balance is $2,614. Again, this is a short, very concise scenario that we're using here with 3 different funds, but it's to show the power of dollar cost averaging. You don't have to panic when it goes down because now you're buying more shares. Look at this. You got 25 shares, 22 shares, 20 shares. And then as the price is going up, you have that many more shares that are accumulating that increase. So even though you had an initial drop, it's that long-term increase. So if you were to look at that and say, I started at $20 per share, but it's down to $18 a share, you would in your mind probably think, oh, I've lost money. Where in fact, this scenario had the best outcome of all 3. And now you're at a place where you're only paying $18 a share. If we were to continue this down for another 10 scenarios and it continued to climb like scenario 1 did, now you're really going to accumulate because you've accumulated so many more shares. That's the power of dollar cost averaging. Don't try to time the market. It's about time in the market. Nobody knows what the market's going to do, but if you dollar cost average, it evens out that volatility. And in the long term, 85% of professionals don't outpace the S&P 500 because emotions always lose when it's time to invest. And this is where you can see this in this very simple scenario in this small little chart of how that works. What are your thoughts on this? Do you dollar cost average or do you try to time the market? Do you try to find the dips, sell on the highs, buy on the lows? Have you done that before? Has it got the best of you? Or are you sticking with dollar cost averaging? Because in the long run, dollar cost averaging is how you make the money. Hit that like and subscribe button. Don't forget to hit the bell to be notified of upcoming videos. And we'll see you next time on Simply Money.